welcome to the Real Estate Investing Made Simple. Hello, everybody. I do interviews live with experts and leaders in the real estate investing world nationally. I'm LeAnn Riley. I'm a national coach, and I built a $14 million portfolio in residential, multifamily, condo development, commercial, and vacation properties. My proven profit formula coaching program helps ambitious people build a step-by-step roadmap to wealth by creating a real estate portfolio of cash flow properties. I'm a real estate broker also, and I lead the Encore investment team of realtors in the Twin Cities, Minnesota, under Realty Group. So if you want to know more, and I have all these interviews, these live streams I do, they're on my YouTube channel, and it's called LeAnn Riley Real Estate. And so be sure and subscribe if you get over there. Now, is only view for host and panelists, not everyone. Can everyone see me? Somebody put it in the chat. Somebody wrote in there, like the view. Okay, let me check the view. It's on gallery. That should be all of us, right? Follow host view. I'm going to go to gallery there. I think that, okay, good. Eric, thank you. All right. So today's topic, what direction are the mortgage rates going? Up or down, or who knows, to outer space? So we're going to talk about what is keeping the rates high, and then what has to happen for the rates to go down. And then options to adjust, because we just have to work with what it is. So how do we as investors or people buying homes adjust? Or as an investor, how do you still cash flow with the rates being what they are? So my guest today is Tim Swierczek, and he is a true real estate entrepreneur. He owns investment property, but today he's coming to us as a mortgage expert. He's been an originator for over 22 years, and he's currently with Gold Star Mortgage. Tim's kind of a mortgage geek. That's why I love talking to him. He really studies what's behind all this, and he knows a lot about how these economic things change. And he can handle complex income or unique customer situations. Really, he's good at creative financing. And he is a former president of the Minnesota Mortgage Association. So, Tim, I'm going to start out with, you're an investor. So tell us, what and when did you start investing in real estate?
Yeah, I don't count my first home, although I did do what they call a house hack. It was a single family, right? And I just wanted a roommate because I thought, why would I want to pay the whole bill if I could have someone live with me, right? So back before they called it house hacking, I house hacked, but I don't count that. My first investment property I purchased in December of 2003. It's very memorable. Not only was it my first, but the seller was broke down crying at closing, and we had to stop the closing several times because she just couldn't, keep herself together. And I was her best option. I paid more than anyone else, right? But she was just in a bad situation, unfortunately. We held that property for 15 years, and it was very good for us, but it was a tricky deal. And I did what's now called a BRRRR on it. I actually purchased it using a combination of things. I used a loan, but I didn't have enough money for the down payment on the loan. So I used credit cards and personal loans from private money investors, including one you might call a loan shark, to get the property purchased and rehabbed. And when we were done with the rehab, we refinanced and pulled 100% of our cash out. So I didn't cash flow much, but I had zero invested. Some people might say, like in current, like if you read a lot of the forums, they might have thought I was crazy, but I think they're crazy. And I'll explain what I mean by that is this. I made about, if you just took the gross rents and you subtracted our monthly costs, the mortgage and the utilities, none of the repairs, I made about 100 to 150 a month. Okay. Back then, actually, that was pretty good. Most of my customers were negative cash flow because it was a quickly growing appreciation market and rents were really low back then. So most people were buying it, selling a year or two later, losing money every month, but making money on the sale. Okay. This is back in 03. Anyway, long story longer. I didn't cash flow very well, but I had zero money into it. So even if I did have to pay a little bit, it was, most people would have to put 20% in to have probably a pretty meager cash flow. I had zero in. So if I had to put 1,000 or 2 into a repair, I was still what, like 30,000-40,000 less than someone else into the same property. So anyway, that was my first property, and we've had many more since then. We've done everything from mostly long-term rentals. We're doing some flipping now. We're doing some contract for deeds. We're doing some apartment deals, and I'm going to have one short-term rental as of 1 week from yesterday.
Wow. I love that story because so many people, that first deal is tough. It's really tough thing, it has to be creative or what, like you say, you didn't have any money. I used a credit card for my closing costs, on my first deal too. I was maxed out,
Yeah.
And I've done that on other deals too. I even we built a big house at one point in Ham Lake, and I remember down to the narrow because all the add-ons from building, I had to borrow 5,000 from a friend on like a personal note at the last minute. That's how tight things are. And they always work out. And that's the risk level that smart investors will go on. It was mitigated. It was planned. It was, just a pinch short, but it wasn't a negative by any means. So, okay, now we're going to get into, numbers and money. That's really what investing is about, right? That's the fundamentals. And those are the two fundamentals that affect the biggie, our life. And right now, low inventory and mortgage rates are affecting a lot of people who would want to move, but just can't seem to put it together right now.
Absolutely. There's a ton of pent-up demand.
There's a ton of that. So let's break down what is happening in the mortgage world. So is inflation really what's influencing the mortgage rates? Help us understand that.
Yeah, it really is. So mortgages are an investment, right? So we use them as debt, but other people invest in our mortgages. They purchase investments that end up becoming your mortgage, right? They're called mortgage-backed securities, and they're most comparable to bonds. They are a type of bond, okay? They're considered extremely safe. That's why someone would invest in them, but that means that they're safe because you just the odds of losing money on the actual investment, the principal, are very low. As we know, during the mortgage crash, it can happen, but they're extraordinarily low. Like there's 1 or 2 examples in history, so right. Compared to like most of us have lost money in the stock market in the last few weeks, I would think if you're in it and every couple of years you're talking about losing money in the stock market, right? And it can be, major percentages of your whole net worth that can be lost, right? Well, that's not common in mortgages. So people typically will invest in bonds when they want low risk. That also means when you have low risk, you also have low upside, right? I mean, the amount of profit is not very great. And so when you look at investing in something that's not likely to lose you money in principal, but it also is not likely to make you much, inflation becomes a much bigger concern because inflation then eats away at your profits. And if the profits aren't very high, you could actually lose money because you're not making enough to keep up with inflation, right?
Yep.
That's essentially, like, in a very, simplified way, that's what's going on. So yes, the arch enemy, the kryptonite of mortgage rates is actually inflation. It's not what people would think. It's the opposite of what people think. Most people think it's recession. Recessions cause rates to go down. They don't inherently cause rates to go down. There's nothing better than a bad economy for mortgage rates. Those improve mortgage rates. Because then because when there's a bad economy, if you just look at a global supply of investment money, there's the money people invest. And I'm not even talking about you and me. I'm really talking about hedge fund managers, pension fund managers, gigantic funds, right? Where they're shifting their money in bulk depends on on what's going on in the market and how risky it is. As the economy gets worse, more money goes into bonds. The more money that goes into bonds, that's more that money has to get spent, and when it's not, and when it's not spent, it's not making anything, right? So the yields, the amount that the investor gets goes down, not up. It's only so interest rates for a bond, or the amount the bondholder gets, the investor in the mortgage gets, goes up as less people want to invest in them, right? Less people want to invest in when the economy is good. They want to invest in Best Buy because they know people are buying TVs. They want to invest in car companies and travel and all these other things because they know people are door dashing, right? When people DoorDash less, you invest less in DoorDash and more into bonds, with one exception: when mortgage rate, or when inflation's high. So when we see a reduction in inflation and a stabilization in that, more money will flow into bonds. It won't be you and I doing it. It'll be the pension funds. It'll be the big funds. And that's what's generally going to bring down mortgage rates, more or less.
Okay. Wow.
Yeah.
Oof. So inflation is really what's keeping the rates high.
Yeah, absolutely. It's not even the, people talk about like the Federal Reserve, and the Federal Reserve has an element in inflation and some other things. But the thing that we see published, like the prime rate and the Fed funds rate, those are not directly related to mortgages. They are indirectly related to mortgage, no question, but directly they're not. And very often when the Fed raises rates, it lowers mortgage rates. But it's not a straight line. You have to kind of look at a long-term view. If you look at a couple-year period, you'll see there's still ups and downs, but the trends, what we'll see is, like, like right now, if we look at inflation going up, right? And inflation's going up, the Fed does a rate hike, right, which would increase their rates. You'll see mortgage rates dip a little bit, but then they're still going to go on that same trajectory because they haven't solved the inflation problem yet. But eventually you'll see it kind of tricking down, and it looks a little bit like a stair, with a lot of noise in between, right? Because mortgage rates change on a daily basis. But if you kind of drew a line through them and said, what's the direction, you will see them slowly going down. But it kind of is a little bit slow, and then it just drops off, right? When everything's good, all of a sudden you'll see them really start to go.
Huh. Okay. And with these higher rates, what might be your suggestions to help make the numbers work? Like, even take that first-time home buyer who could have gotten in but didn't maybe a year and a half ago. Is there any solution?
There is, and I almost wish I had someone on the call that I could ask this question to, but I'll ask you, LeAnn. If you were a first-time home buyer, what do you think is going to happen to the price of the home you're going to buy in 2 years if interest rates go down significantly because inflation's under control? And there's been a high demand for houses, and people haven't been able to buy in the last 2 years because they were afraid of high interest rates. What do you think would happen to the house you want to buy?
The prices are going up. We know this.
Yeah.
Because
Yeah.
now there's a stampede to go buy it. And it will be back to right after COVID, where it was just nuts.
Yeah. You and I know that. The problem is most people don't see that, or they don't look that far out, right? But that's exactly what's going to happen. The stats are all there. Everyone who's paying attention knows that's what's going to happen. Is your $200,000 house is going to go up to 240 or 250 in a 12-month period. Yep. And it'll be increasing at some point $5,000 to $10,000 a month. Not right away, right? It's not a linear thing. It'll start going up like a couple grand a month, then $5,000 a month. The next thing you know, it's going to be shooting up $10,000 a month on these houses for several months, right? Until it all of a sudden caps out, right? The $300,000 house is the same thing, but they're going to go up to 360, right? We're going to see some massive increases in prices. And there's the good news is there's a solution. And you know this, you know exactly what I'm about to say, but you can get a house today at today's price, let's call it 300,000. And when it's worth 360 and rates are really low, you can get the 360 rate that people are getting to purchase their house at 360. They're getting a rate of, let's say, let's call it 4%. We don't know that that's what it'll be. Let's say it's 4%. Let's say you're at 7% now. You can have the 4% in the future in the $300,000 price today. But you just have to have a little gumption, a little, cojones, whatever you want to call it, right? You have to be willing to trust that that's what's going to happen. But the fact of the matter is, it's not that big of a leap of faith. This is if you look at history, that's exactly what has and will happen again. We just don't know the exact dates, right? We don't know the exact amount of the rates, but we can project. And Fannie Mae, Freddie Mac, and the national economists all project this stuff. They have to. And they're projecting rates in the mid fives by next year. Okay. Now, are they going to be right? We don't know. But are they going to be in the mid fives in the next 2 years? Absolutely. I think you could bet a lot of money on that. Anyway, go ahead. You're going to say something.
Well, exactly what maybe the biggest piece of this quotient is the inventory is terribly low. It's record low. And the thing about housing inventory, its spike can't go fast. It's a slow turtle to raise. And so all of that's happening, but the inventory will never be there for those lower, like you say, to buy and it'll drive the prices up because inventory just doesn't grow that fast. It just doesn't. They're not building enough.
We're talking basically, again, these numbers change every year. But we're talking basically 1.5 million new homes every year. That's it. And people say, oh, they're building everywhere. They're building like crazy. No, you're looking at 60 homes. They're not building like crazy. It's not even close. They're not even keeping up with the number of births in the hospital. So yeah, it's when you start really looking into those numbers, it's really, really eye-opening. And it makes you want to buy more, which is why I've had my most aggressive year in my entire career in the last 12 months. I bought in more properties and done more real estate investing in this market because it's actually easier. It really is. Now, it's hard to find deals where you're just going to go start bragging to your friends about them. Matter of fact, I don't brag to my friends about my deals, but I'm already making money on bad rates. Just imagine what's going to happen when they're good.
Exactly. You really have to, like you say, have that chutzpah or something to go ahead and trust that it will come down. But now is the time to buy versus when the crowd is stampeding the place and there's a line out the front door waiting to view it, and there's 30 offers,
Exactly.
Yeah. So what I've noticed from the realtor side is even there with this tightness, there's tighter guidelines over there on the mortgage side. They're tightening their ship, right? And what I notice over here is even the appraisers are tighter. They're flagging things that never got flagged before. And there's just a tightness in the market. What about that? Is that going to stay?
Well, I mean, I think what you're probably in many ways, what you're referring to, what I see as the tightening on my side is that people's ability to purchase, consequently, their leeway often is reduced greatly. And it has a lot to do with the higher interest rates, right? I mean, there's no question that affects someone's ability to pay a payment, right? I mean, it will reduce their maximum house price, right? As far as like lender guidelines themselves, surprisingly, they're not really tightening at all. You sent that question. I could only think of one example of a true tightening, and it was very minor. And I'll explain it because it's really easy and it applies to if you're living in a home and you're getting a conventional loan on your new home. Doesn't matter what your current loan is. If you do that, they call that convert, and you want to keep your home as a rental. They call that converting your home, right? You're converting it to a rental. On those conversions to rentals on the home that you're leaving, it used to be that you just needed a signed lease and 1 month's rent in order to count the rent from the house you're leaving to for the new loan. They've now changed that. Both Fannie Mae and Freddie Mac have changed that to 2 months. So you need 1 month's rent and 1 month security deposit in order to use the rent from the house you're leaving on the new home. And they don't accept less than 1 month's rent for the security deposit for those purposes. Meaning that if you just said, hey, LeAnn, you're a great risk, I'm not worried about it, I'll only charge you $500 for your security deposit. You can do that, but then you cannot use the rent. And that's a recent change. Outside of that, everything's been better. Now, it's all minor, don't get me wrong, but they've been loosening the guidelines. What they're not loosening, or what you're really feeling, is just people's pinch in their budget. That's what you're feeling.
Yeah, it could be, but I'm also seeing it like you say on the refi end for sure. If an investor, could have got a loan before for 20% down and now it's 25. And then once they look at the deal and their stuff, it might even be 30 that.
Yeah, I had that happen on an apartment building. Matter of fact, we're closing on an apartment building in a week, and that's exactly what happened. The down payment started off as 20%. It's 35 now. Yeah.
Yeah. So that feels like tightening to me.
It is, and that's I get, yeah, but see that's related. But so the funny thing is that's not related to the guidelines. It's more related to the It's I absolutely agree with you that it's a tightening, but it's not because the guidelines got tighter. It's because the deal doesn't work without the extra down payment, right? It's more of a fundamentals of the math behind it than a like, hey, we won't lend to you 20%. If the cash flow was there, they would have lent me the 20% in the apartment building. It was because the rents don't justify the rate, the mortgage I have to pay because of the rate, right? So it's all a function of that rate thing, which again, it makes it harder, but we think so. We're buying this apartment building for, and I'll keep this simple, for $74,000 a door. My property manager out there just refinanced a property for $122,000 a door. Now that property that he refinanced is nicer because it's remodeled, but we're gonna own our property for $100,000 or less per door, and it'll be worth $122 a door. Right? That would not happen if interest rates were 4%. I'd be paying $122 a door to get this place, and still have it in its current condition,
Yeah, and it would still need rehab.
Yes, exactly.
Yes, but because you're buying it now, you had more negotiation power.
Yeah. And to be perfectly blunt, so everyone's clear, very little cash flow. It's not a great cash flow play, but it cash flows enough at the current rates that we don't need rates to go down to make the deal work. That's about as good as I can say about it, because otherwise it's a pretty low return, one I wouldn't normally accept. But again, it's going to pay for itself. It's going to cash flow, and we're going to pay all of our expenses. We're still going to be putting money away for repairs. We're going to have a fully remodeled property. And when rates go down, this thing's going to be worth quite a bit more than $122 a door. We might make $50,000 per door on this deal. I'm not guaranteeing we'll make that, but that is not out of the question.
See, you have to really understand the numbers and think longer term. It's not only what you got today, and you have to trust that in the next year or two, the rates will be in that 5-ish or something less than where you're at today. Probably worth that refi, and that will help the gap.
Yeah. And I think all this comes from something that both you and I already have, which is just that experience and the confidence to know what could happen, right? I can look at this deal and see why I would have to do it. It all starts with your first deal. Like you mentioned, the first deal is the toughest, and getting some of those deals under your belt. And the money I'm investing in this property all came from real estate investing. It's not like I took my day job and saved up, several $100,000. No, I did that through real estate investing, and made that money and didn't spend it and use it to buy other real estate.
Yeah, so you're less attached because it's the monopoly game spinning around.
Exactly.
Yeah, I totally get it. There is a question about a mortgage there. See it in the Q&A? Can you see it?
I actually only see something about, so maybe I didn't scroll enough. I see something about seller's market, but no.
No, I'm going to read it out to you. It says,
yeah, I don't see it.
Yeah, I'm trying to close an assumable loan, 13 units. It's a deal at 4.68%.
Okay.
5 years left. It's $1 million loan. What would be the forecasted risk on this loan instead of going for a new loan?
Oh, I wouldn't go for a new loan. Well, I shouldn't say that. I doubt I would go for a new loan, because that 4 points, so right now I just shopped for mortgages in the Tennessee market, but I shopped Minnesota and Tennessee lenders. The second best interest rate I found was 8%. Okay. Wow. The first best was 7.6 after negotiation. It was actually 7.8. I told them I couldn't do anything over 7.5, and we settled at 7.6. Okay. So that is what your risk is. It's a 3% difference to get the new rate. Now, what's the difference? So everyone, because this person might know this, but not everyone listening might know this. The difference is, like, it's $1 million loan, but if this person's paying 1.5 for the place, she or he, I think you said she, has to make up the $500,000 difference. So the benefit of the new loan is, in theory, you could have a lower down payment. Okay. But I don't know enough specifics to know where that is. And you would still have to be able to cash flow at that lower down payment, right? I mean, in theory, I could have had 20% down on my apartment purchase, but the reality is it was 35. So theory and practice are two different things. You have to dig in a little deeper, but I would definitely assume that loan if you can, and you can come up with the down payment. You won't find a better rate even in the next 5 years. If you find a better rate, just go get a new one, right? You don't actually have to keep that loan. Now, again, another thing people might not know, and it would be worth it for this person to know, is what the prepayment penalty is. Most commercial deals have some form of prepayment penalty, and especially the assumable ones, they make them assumable because they don't want to give up that loan. It's an investment someone invested in, and they're interested in keeping it through the length of the loan usually.
Okay, and so now what about what we do see out there right now is these buy downs, and they're even having the seller pay for the buy down. That's one of the ways they're trying to close the gap, right?
Yep, absolutely. And I think it's a good one when it's needed. So I like to think of it like this. So first of all, there's two different types of buy downs in the conventional and FHA world, right? And I'm not talking commercial or anything else, but in conventional and FHA, you can have a temporary buy down and a full buy down. The temporary buy down is essentially a bank account that subsidizes your mortgage for a couple year period. And there are different terms. It's typically 2 or 3 years. So what might be normal, again, making up all these numbers, let's say your interest rate today was 8%. It would probably be a little less, but pretend it's 8%. For the first year, your payment would be as if it's a 6% interest rate. And then your second year would be as if it's a 7% rate. In your third year, it would be at the full rate of 8%. And there's money in an account that basically you're paying the majority of the payment, and the difference in those interest rates is coming out of that account each month. It's all on schedule. You don't have to do anything. It's like magic, right? It just goes in there. And then at the end, when the money is gone, you're paying the full 8%. Now, the nice thing about a temporary one, and the reason why I like temporary buy downs, if you can get them, is because if any of this money is unused, you get it back. So you don't waste it, right? And so if interest rates go down from 8% to 5.5% next year, and you refinance, if you did a permanent buy down, any money you put into that permanent buy down would be wasted when a 5.5% rate went out. And you'd be silly not to take the 5.5% rate. So you're wasting maybe tens of thousands, certainly a lot of money, right? But on a temporary buy down, you get whatever unused money, you just get it. So it's no problem. Okay. And so that's a very good thing. It helps make the house more affordable, but it does not change your debt to income or your ability to buy more property. It's more psychological. It makes you be able to afford it in your head, but on a lender on paper, it doesn't change anything. Okay. The permanent buy down, we use a lot of these. You have the risk of wasting that money, but what it does do is it permanently changes your rate. So you go from 5% to 7.5%, or I'm sorry, 8% to 7.5%. The ratio is not nearly as big, but it's permanent. It's for the life of the loan. So then it does affect the debt to income, and you can qualify for more.
Is
right?
there penalties on those though? What if you have, like it's a 3, 2, 1 buy down or whatever, and then in year 2 you refinance? Is there a penalty snuck in there?
No, not at all. That's what I was saying. That's the temporary buy down. There's no penalty.
Oh, okay.
Permanent one there is, but it's all up front. They don't call it a penalty. It's just wasted money. It's like paying points, right? I mean, it is paying points.
Yeah.
So you pay. I mean, in some cases, I've had people do a permanent buy down on an FHA loan. They'll allow the seller to pay 6% towards your interest rate. 6% should drop your rate really close to 2 points. So you could go from 8% to 6% permanently. But that's going to cost you, depending on the size of the loan. I think the last one I did was about $30,000, roughly. It was about a $500,000 property, roughly speaking, and the seller paid about $30,000 to get the rate down. But it was a full 2 points. It was a solid 2 points. Okay, but if rates go down to 5.5, you put $30,000 in it, and you're still a half point above market, right? So it is kind of wasted money. Now the catch is, in this case, my buyer would not own this house without that. So there's some value there. And if they, you know what I mean? So like, I guess who cares if it's wasted at that point? Because you don't own it otherwise. You have zero, right? So it was a good deal for my buyer, even though that was the case. And some people, now, if you're house hacking and you're trying to do things quickly, you might not be able to refinance fast enough to be able to get the lower rate anyway. And in those cases, if someone's not using me, I'm still recommending to you, my recommendation is you look at a full-time buy down if you're going to be very aggressive in turning houses quickly. If you're going to try to buy one this year, buy another one in less than 2 years, because you got to remember, you got to refinance, and you are going to want to refinance as an owner occupied property. Well, most people think you buy a house and you have to keep it for 1 year, then you can move out. No, you have to keep the mortgage for 1 year. So if you refinance, you got another year before you can get another owner occupied loan, right? Even if so, right? So if you refinance, it resets that clock. So due to that, I basically say you should have to plan on being in it for 2 years. Otherwise, you should buy the rate down permanently, aggressively if you can, and use someone like LeAnn to look at properties that are distressed where the seller is willing to pay $30,000, right? Because not every property you can. And if you're just looking on the market for places that have great kitchens, you're going to lose money. You need someone like LeAnn to go, I'm sorry, LeAnn, sorry, I don't know why I said Rand, but LeAnn to go, hey, don't look at this. I got another set of properties you should look at where you can get a 6% rate today. Here's what we'll do to make your property worth more. And then you're not going to have to worry about refinancing because you're going to be good. You can move out in a year, right? But you need skill to do that. It's not your parents are not going to help you through that. Right?
I like what you said, because people aren't thinking that the refi of living in that owner occupied thing triggers a start the year over.
Yeah. We got to think 2-3 years ahead. If you're not doing it right. Like, and again, I don't expect people on this to necessarily think that way, right? But I mean, the reality is you and I are already there, right? I'm absolutely thinking, multiple years ahead right now with every client and also with my own things, right? Because that's how you find deals. They're not just like, it's like they're camouflaged, but if you can see through the camouflage, it's actually quite easy.
That's a very good way to put this. So you've been in this business over 20 years. Like, does the job market have to shift, or what really has to happen for the rates to go down? What's going to be the thing?
Well, I mean, I think part of it now, here's where I'm gonna go back to say the Fed has an indirect relationship. The Fed has to really see that inflation is going down, I think, is part of it. If you look at the indicators, I would argue that inflation is going down, but some of these things lag. And the best way I can describe the easiest way people understand it is this. If you look at rents right now, the rents look like the inflation on rents is still really high. It looks like it's in the 7% range per year, but it's not. The reason why it looks like that is because rents are 12 months behind. When you're signing a lease, it takes 12 months for that rent to that lease to renew. But those renewals are happening at 3%, which is totally normal rent increase, right? Yeah, but it doesn't look like that on paper. So the Fed, and that's 39% of core CPI. So nearly 40% of inflation is based on something that's been changing for months, but doesn't look quite like it yet. And here's another one. Oil was down to $77 a barrel, which is a 16% reduction since last October. Okay. That is also affecting things, but it doesn't happen overnight, especially going down. It does going up, right? Because when prices go up on oil and shipping costs, you guarantee that those shippers are changing it right away. But when they go down and they go down slowly, they suck up the profits they lost before they lower their shipping costs. They wait till the competition lowers, right? And everyone's playing a game of chicken. How long can we wait? But it's coming down. So there's a few other things too. Let's see here. Used car prices. This was a big one this summer. We were expecting in May 10th, we thought inflation would show a big drop, and I predicted it. I was talking about it all over the place. It didn't. The reason why was because used car prices were up huge. Used car prices are down 2.3% month over month. So there's some big drops in there, and these things are going to start showing up in our inflation numbers. When they do, the Fed's going to back off. People are going to start feeling more comfortable. You'll hear the media start talking about it. And in the end, they will see mortgage rates start to drop.
So it's many factors working together, but really the key that I heard was it's the lagging data. The data is old, and we're making decisions based on the lease description. Really helped me see it. Yeah.
Yeah, there's quite a bit of lag built into the system, both directions, but it lags more on the way down than it does on the way up. It just always does. And that's true of mortgage rates too. Okay, thank you, Benny. I'm on a meeting right now.
Yeah, I got home from school.
Awesome.
We
That's
get-
Benny.
And
Yes,
the dog.
Yep, exactly. So
This is the work from home culture.
this is the work from home culture, and someday Benny will own our real estate, right?
That's right. That's right. They already know. Okay, so are you seeing a lot more creative financing type deals, just coming across your desk because they need a mortgage for a piece of it, but not all of it, because there's some other stuff in there?
I'm seeing so much more that it's hard to characterize because it was zero and now it's some, right? So like someone brought up in the chat earlier about an assumption. That's the third assumption I've talked about this year. And most of them I think actually were probably within the last 3 or 4 months, but that was zero for 20 years.
Oh, yeah.
Zero. Yeah, zero. Like I don't know anyone who's assumed a mortgage in the last 20 years until the last couple months, right?
Wow.
So there's one example, right? But other examples, if you hear the term subject to and all this other stuff, and I'm actually involved in some of that. I mentioned contract for deed. Well, I'm buying properties for people who don't qualify for mortgages and then selling to them on a contract for deed. That's a form of creative financing for them. I'm using traditional financing, basically marking it up and selling it to them. It's a lot like a landlord, but I have a lot less responsibility, right? There's pros and cons to that, but that's a form of creative financing, and people are open to it right now where they weren't before. So absolutely. There's groups, there's Facebook groups, there's all kinds of things happening around creative financing. And that is another way around this, right? Like trying to jam a square peg in a round hole will make you sick, tired, hate investing. You'll put your money in the stock market and lose 20% next year. I'm exaggerating, but you know what I mean? So yeah, don't try to do that. Look for better ways. Get educated with your program, get educated, work with professionals, and find things that are working. If you say, well, I'm only going to invest this way, that's going to work sometimes, but there's a lot of time it won't work, right?
Oh, especially in real estate. Things are changing. The market's changing. The inventory is changing. The financing is changing. You better work with someone who understands that or can refer you to someone like you, Tim, that, you've been around long enough. We've seen those other things. We know how they kind of went. Maybe this same movement will go sort of like that. It gives us a little bit of wisdom in what it looks like. But yeah, I did a ton of deals creatively because, interest rate was 18% when I was investing. When I got started, it was 18%, but I didn't blink twice. Yeah. I didn't even know that it was anything else before. You know what I mean? That's all I knew. Okay, what do I do then? How do I do it?
I lost a mortgage to someone who did creative financing in a house in Houston, Texas, a couple of months ago. I'm fine with it. Not, not saying anything bad about it. I actually encouraged them to do it once I found out it was a possibility. I'm like, we'll get you on the next one, right? Someday it'll be worth it for them to refi. And I think this is a good point too. I don't care if you have a 2% rate today. There's a point to where that rate's going to cost you money and you should have a 5% rate. And you'll know when that happens, when there's enough equity that it could buy you another property that you'd make more on that property than you're losing on the 3% difference, right? And so that's the simple way of explaining it. But the bottom line is it will always happen. Always. There'll be a time where a 2% rate is the worst thing you could have. And when you fall in love with it and hug it like it's a bunny, you're making a big mistake. It's just a rate and it only matters until it doesn't.
Well, this is really all about the velocity of money. Yeah. It's not just that one deal that makes X, it's all the components put together.
Yeah, absolutely.
So now I'm going to ask you the big question. So in Tim's world and with your knowledge, where are these darn rates headed? Yeah.
In the short term, it's extraordinarily difficult to say. We're on a 1 week drop in interest rates. They're for the last week, they've been below the 25-day moving average, right? So they average it out and move it, and they're below that, but they stopped at the 50-day moving average. If they drop below that, we're in for some nice gains, but that still might only bring us back to last to this summer, right? I mean, they're significantly higher than they were just a few months ago.
Oh, yeah.
So in the short term, there's a lot of volatility, and I wouldn't even begin to say that I think it's going to be better or worse. We're looking like there's a little bit of rally, but it wouldn't take much for that to change, right? One bad inflation report, there's a couple other things that could cause that to be worse. Actually, anything getting better in the economy could make rates go the other direction for the other reason I mentioned, right? So there's plenty of things that could make them worse in the short term. In the long term, though, if you look at like when the Fed starts increasing their interest rate, and you look at how long it typically takes for inflation to come down, that period's often 18 to 24 months. Okay. If we look at that, combined with the fact that they went very aggressive. So a normal Fed cycle, they'll increase it 25 basis points at a time. They did 75. They did 3 times as much as what's normal. If you look at all that, I do think that 18-month period is quite likely. It just so happens that also corresponds with a few months before the next presidential election. And so I think there's a lot of pressure on politicians. Keep in mind, even the Federal Reserve is an appointed position. And even if the person who's in power gets elected or does not making any claims here, but even if that person were to lose out, the Federal Reserve wants to look good for the next guy, otherwise they're going to be replaced. There's a lot of pressure for them to get rates down before the election, even if it's temporary, right? I'm not talking, so I think that that's a very likely time frame, like let's call it August, to see some rates lower. Not a guarantee, but I think it's likely. And Fannie Mae and Freddie Mac are projecting similar timeframes. So I think there's a good chance, right? But I think, like, let's say that fails. Let's say that's wrong. Well, guess what happens? So like if you look at Bill Clinton, if you look at Obama, and you look at Trump, all 3 of them put in stimulus packages when they came into office, their first 100 days. Well, what typically in a stimulus package, one of the best things you want to stimulate is the housing market, because it fuels so many other things, right? You've got movers, you got realtors, you've got stagers, you've got manufacturers of all kinds of housing goods. Home Depot sells a lot of stuff. Every time someone moves in, they're buying all kinds of things, right? So you've got all that. And I think it's highly likely that the next president, whether it's the same president or a new one, would want to put some stimulus in next January. And then you might see some drops then. They'll be artificial. They'll cause more inflation, but it is what it is. And I think that's highly likely.
Interesting. Okay. And does low inventory affect those rates, since we're still in this seller's market? Does that have anything to do with the rates, or really not?
It has nothing to do with the rates, but it does affect the price you pay. Yeah. So like, I do think this, I will say that the low inventory is the reason why the housing market stayed so strong when rates went up. Because normally you'd say this, like I told you, like if rates come down, the prices are going to go up, right? So you'd say, well, Tim, that means how could that be? Rates went up and housing pricing still went up. Well, that is a function of what you're talking about here.
Yeah.
I don't think people have any clue really on how bad it is. We have such a dysfunctional seller's market that we are I saw someone mention that it's a buyer's market, and I admit that housing pricing's dropped a little bit, so you could argue that that's the case temporarily, but we have such an inventory problem that we are on the verge of a seller's market for decades, like one that won't go away. It will always be a seller's market because we're not building enough. And no one likes to talk about this. It's a little bit morbid, but there's really only 2 ways to get a new house, okay? Because everything else is trading houses. If you go and sell and I buy your house, we didn't create a new house. I just bought your house. We traded, right? You bought someone else's. The only way you get a new house is you build one, or everyone in the house dies, right? Because just one death isn't enough. If you're married, you need 2 deaths, right? Again, morbid, but it's true. So we really are not recycling homes fast enough. There's not enough deaths. There's not enough building, but there's plenty of births. And there's plenty of immigration and plenty of other things. The good news for real estate investors is I think that you're in for a boom, decades long boom. No, you might have some ups and downs. I'm not saying that every year will be a boom. I'm just talking like if you drew it out and you say, I'm investing for the next 30 years, I think you're in good shape and you're going to make a lot of money. even though I think you could lose money in any given year, right? Again, I'm not saying that it's always gonna be perfect, but I think we're looking at huge gains over the next few decades.
Yeah, and that's inventory related, and I like your explanation. Also, the population, lives longer. So
Yeah,
again, that's stalling the inventory too.
yeah, absolutely,
Yeah.
absolutely.
I call it the big shuffle. I gave it a name now about what's coming. The rates are going to come down. Everybody's going to refi. And the big shuffle is those lines out the doors to look at new houses or offers. The prices are going up, period.
Mhm.
We've seen it. We know it. Yeah. And it's the big shuffle because it's a battle, believe me, on the realtor side here, when there's just so much activity like that. It's difficult to work through it all and even figure out which offer to accept.
Exactly. So you have to be able to get people's attention, right? Right now, you have their attention and they're not giving away houses. I mean, I think what's happening, like year over year pricing, you'd know better than me. I think it's still going up. When I say pricing's going down, I'm really talking about the amount of profit. It's not appreciating as much, right? People are putting their house on the market for 400, but they're selling it for 380, not because it was ever worth 400. They were just hoping they could get 400, and the reality was they missed the target on where it was headed, right? But it was 360 last year. You know what I mean? It
Right.
didn't go
Well,
down. It just didn't go up
that's
as
a
much.
lagging number too. If you look back, well, my neighbor sold for 400. Yeah, they did a year and a half ago. That it's
Yeah.
lagging. If you're using lagging data, it's always
Yeah.
changing, just as the mortgage rates. We just don't get a report every day,
Yeah.
5 times a day or whatever. Okay, so yeah, what we realtors say, there's actually an opportunity now, which is what you just said. Buy now while you can negotiate something. And also, winter is coming. And I have experienced every time in the winter, we get good deals. And it's simply because it's cold out and people don't want to go out there. And the
Yep.
ones who do go out there, there's some good stuff out there if you're willing to go freeze to get it.
Mm-hmm. No, it's true. I used to sell cars, and this is a good example. I was doing really bad, and I was thinking about quitting. I talked to my boss, and it was December, and he said, "Tim, throw on some long underwear and work hard in January." And I was the number one salesman at the dealership. Never looked back. That year, I was in the top 50 in the U.S. for salesmen, and it was that wearing that long underwear and going, you know what, I'm going to brave the cold when no one else would. I sold more cars than anyone else because they didn't want to go outside, and I didn't care.
Uh,
Right. And the same thing can happen in real estate too.
I
Absolutely.
have
You
seen
buy
it.
the stinky house, you know what I mean? Go do the stuff other people don't want to do.
That's
If
right.
you're looking to buy the perfect house in Woodbury that needs no work, well, guess what? You're not going to make very much.
Right. But the stinky house, I say get ahead of the pack. Go, brave that winter.
Yeah.
Don't wait, because just as I agree with you, it's coming. It's going to go down whenever it does. And it's better to buy now.
Last December, I did 2 6% buy downs, meaning had FHA loan where they use 6% buy downs. And I'm confident I can guarantee you, everyone on this call, that if it wasn't December and they didn't get that buy down, they would never own those houses, right?
Mhm.
But they bought at the right time when no one else wanted to look. Sellers who wanted to sell, they used the right realtor who knew that these sellers wanted to sell. There are indications, it's not perfect, but there are definitely, sellers who are more likely to want to sell, and if you use the right realtor, they can help you find them, right? And that's, I think, what a lot of people don't get is they think just because their aunt is a part-time realtor but works at corporate 3M or US Bank 40 hours a week, that's the right person to help them find a house, and it's completely wrong. But they don't get that. Unfortunately, they think that they don't see the value of good education. They think, oh, because I can look on Zillow, I don't need a realtor. Well, no, that's not what a realtor is for. It's for education, advice, negotiation, right?
Well, there's tactics, believe me.
I know.
There's tactics, and you need to work with someone who understands that and knows how to. I drove the price up on something using my skills.
Yep.
And, we got 35,000 over ask in today's market, no
Yeah.
problem in one weekend. But it was a certain system.
Yeah.
That works.
Exactly. So I mean, but you can use the system the other way, right? You can use it both ways, to either drive the price up as a seller or to look for
Drive it
depressed
down.
properties.
Yeah.
They might not have a flag on them saying I'm depressed, right? You got to know what to look for. And that's the camouflage I'm talking about, right? That's there's all kinds of things. And so, the key is not trying to pound a square peg in a round hole. So if you're listening to people who have like that little bit of knowledge, like a lot of times, the biggest killer of a deal is our parents, because they're living in a house in Woodbury. They forget that this is their fourth house, and that they did have an FHA mortgage with 3%, 3.5% down on their first home, and they did pay 18%. So 8% shouldn't be a big deal. But they don't have 8% now, they have 2%. So they tell them, oh, wait for rates to go down. Well, no, that's about the stupidest advice you could ever do. Oh, wait till you have 20% down. Oh, wait, so you can pay 20% more for the house, or maybe 40% more for the house, because it takes you twice as long to save up that down payment. No, I mean, this advice is often ridiculous that you get from parents. Right? Ridiculous. And it usually can be proven with math that it's bad, actually. So you need good advice, but it's not from the people who don't know what they're doing.
Right. They have to
They
know
love
that
you, but they don't know.
the industry, whatever industry you're talking about, they need to know that.
Yeah.
Is there any creative financing ideas or anything we need that we haven't covered that we need to know about mortgage wise?
Well, there's a mortgage thing that everyone should probably know on this call. It only applies to owner occupied, but in 10 days, Fannie Mae is changing their guideline. They've already announced it. They just it's not official yet. But in 10 days, you're going to be able to buy a duplex with only 5% down on a Fannie Mae loan with no income cap. Now, currently, you might think, oh, I can do that anyway. Freddie Mac has a 5% down program, but there's an income cap, and that stops a lot of people from buying duplexes, and it completely stops people from buying triplexes or fourplexes on that deal, because the income cap is such that you couldn't afford a house you couldn't afford a triplex with that income cap, right? So this is a pretty big change for house hackers and owner occupants. That's brand new. I couldn't even technically pre-approve someone for it yet, because they haven't given us all the guidelines. They just said it's coming, and the first day I can run it is the 18th of the month. I'm taking applications and kind of telling people what they should qualify for, but we don't know until that comes in. As far as creative financing goes, again, it's more about finding the right deal. The financing, unfortunately, isn't gonna, there's not a magic bullet. There are some things, if you're buying investment properties, I highly recommend commercial portfolio loans. If you're in Minnesota or Wisconsin, or a couple other states, I think we're doing them in Florida and Tennessee. We've got a few states we can do them in. We can help you out, but if not, I would certainly point you in the direction of what to look for. There can be advantages both to price, but also in what they'll allow you to do to get creative.
Yeah, I see that too. So I'm going to end with one last question. There seems to be fear in the market, and a lot of people, that's sort of what's holding them back, is that sort of a fear of, should I do it now or not? How do you handle that fear?
Well, I think it's real. So I mean, I validate it, right? It's a real fear. But I think that it also has to be something that someone has to get past, right? And so where's the fear coming from, and what is the risk? Okay. So then we have to start looking at that. If the fear is that, if the fear is you're buying at the wrong time, you have to look at and say, well, no one really knows what the right time is. But we do know if this current deal will cash flow enough to, let's say, support itself. I don't want to make it sound like it's going to be a great deal, because anyone who finds a great cash flowing deal either got lucky and found 1 out of 1,000, or just isn't calculating it properly to begin with. Right? Because I'm here to tell you, I look at a lot of deals, and we're buying an apartment building that has about 4% cash flow. You know what I mean? It's not very good.
It's not very good, but it still is above water.
Yes, it would be 10% plus if the interest rates were more reasonable, right? Like what they had been. But anyway, so we're getting a good deal. Anyway, the point is this: if it can pay for itself now, when rates go down, you have a couple options. Rates go down and you refinance and you cash flow well, or rates go down, the value goes up so much that you can take the equity from that property and go buy something else that's even more profitable, right? Or if you catch it on the early side and you're smart and you're using a great realtor, you can break it out into a couple properties, right? So, or you can even do another is refinance. Maybe your payment doesn't go down very much and that one doesn't cash flow very much, but you get enough to buy property number two. And it's like a stock split then, right? So there are options, but you have to get over that there's some perfect time to buy, because there isn't. There are profitable times to buy for sure, but you're only going to know them in hindsight.
Yeah,
Right.
that's
I
the
believe I'm
difference.
looking ahead and I'm seeing back already, knowing that I'm doing profitable deals. Actually, I know they are. I mean, because I know this too. As long as I'm willing to wait long enough, someone's going to pay that property off for me. The rents are going to keep going up over time, even if they go down temporarily. And I've got enough money in the bank, right? Like I've got enough stuff figured out that I'm not worried. I'm going to make money on these. How much I make? Well, we don't know that. We'll know that in a decade or two, but I'm going to make a lot. I just don't know how much, right?
Yep. Okay, I do have one last question here. What is
Sure.
better, a HELOC or a refi?
Well, if you've got a low rate now, it's typically going to be the HELOC, right? But there are some exceptions to that, so it's worth mentioning. The HELOC's better typically because of this. You maintain on what would normally be the bigger part of the mortgage, the lower rate, right? So the lower rate being like, let's say a rate in the 2s, 3s, or 4s instead of the 7s or 8s. Your HELOC is going to be a higher rate than what you get on a typical refinance, and it will be variable, but it goes up with the Federal Reserve rate, which we think is at or near the top, right? There's some argument that they might raise it another 25 to 50 basis points, which means a quarter to a half a point. But that's pretty minimal. And then it's going to start tumbling at some point, we think maybe a year or two down the road. And you have built-in refis every 6 weeks at that point, right? With no cost. No cost refis are pretty good. So, and another thing about a HELOC, you only pay interest on the part that's used. It's like a credit card. So if you get a $100,000 HELOC, but you don't use any of it, you pay zero interest, even if it's a high rate. So it's there available for you. And people really underestimate that. They see, whatever, a 10% HELOC rate, and they think, oh my God, I'm paying 10% interest. Well, no, you're paying zero until it's worth it to pay 10% interest. So just find a deal where that makes sense, that's another one. Now, and I flip on my HELOC because right now I don't think you can cash flow at 10% on a rental property, but I can use my HELOC money to flip, and then I can take the profits from the flip and put that into rental properties, right? So there's different ways to invest if you're willing to get creative. And I guarantee you I can make $200,000 paying 12% interest in 12 months. Guaranteed. I've already pretty much done it. We're not quite there yet, but I think on our next sale we'll hit $200,000 paying 12% interest. So anyone tells me that I'd never pay 12% interest, I'd tell them that they are losing somewhere around $185,000 by saying that.
There you go. That's somebody who knows how to work with the mortgage rates, no matter what they are.
Yeah.
Right.
Yep. And it took years to feel that confident, right? And a teammate. The reason why I feel that way is I have a contractor that I trust, right? That's my business partner, right? So it's not all like but it's totally doable. Yeah. Interest rate's only a number. It's one factor. It's an important factor, but it's not the most important factor. Actually, most people look at cost, they don't realize the profit. I mean, you've seen, we made $85,000 on a flip this year. Now that pays for more. That pays for my HELOC that I used for that's $130,000 HELOC. Okay, so $130,000 at 11.25%. You can figure out my maximum I'd pay in interest if I had it maxed out the whole time, which I don't. It wasn't a year's worth of interest, but I paid years worth of interest on one deal. It became free to me for the rest, for years. Now I can keep turning that money, and the quicker I turn it, which is actually my biggest problem, turning it quicker. We had a couple really big deals, and it's not hard when you get a couple good ones and then a couple not so good ones, but still profitable. It adds up.
It does. It does. Okay. Now for people who want to get in touch with Tim, I'm going to share here how you do that. Right here is his phone number and his email. And He's with Gold Star Mortgage. I'm going to read the phone number in case somebody's listening on their earbuds, 651-772-9000. So, and then if anybody wants to do a free strategy session with me to chat real estate, whether it's about coaching or to buy, sell, invest in the Rochester to St. Cloud and the Twin Cities area is what we cover at the Encore Investment Team. You can look on LeAnnRiley.com. There's a place you can schedule a call for either coaching or investing. And the last thing, I do have a Facebook community also here called Real Estate Investing Made Simple. You can join that. Go look for it over there on Facebook. Now I'll go back. Tim, thank you so much. I learned a lot of things, and boy, it sort of excites me to, it's that velocity of money is what business, real estate, all this is about. And pick an area, whatever it is, and apply it. That's what I
agree. I think it took me a really long time to think this way. I would say for the first 15 years of my life, I only thought of one type of investing, and I cost myself so much money, so much. And so I think most people do that. And I think it's totally normal. I'm not here to tear into people, but I do think I need to be a little shocking and let you know that it's completely wrong. And most of the stuff you've learned about investing is wrong. And you should listen to LeAnn and take some coaching and make some real money. Right?
It took me a long time to learn it too, I think. And, the way that I got into investing, my then husband was a handyman, and he worked for he's a big developer now, but at the time he was just a itty bitty real estate investor dude.
Yeah.
And the real thing that happened is, I'm a numbers gal. I figured it out after he rehabbed the whole damn, fourplex for the guy. And I think Philip made, it was under $6 an hour. We paid the subs way more than that. Everybody else got paid money. But bottom line is we didn't. And that investor made a fortune. And I said, okay, I'm in the wrong chair here. I got to figure out how to switch chairs. And, that investor, his name was Ned, he helped me switch chairs. And that's how I got, that first condemned building we bought. Who would be celebrating a condemned triplex? We were.
Yeah.
That's the first one where we got it, Yeah.
I totally get it.
It was out on a limb, but I got out of that wrong chair and those old beliefs, and I converted over to the other side.
Yeah. I went from the guy who thought that I would never sell a property and to someone who sells properties every couple of years, because at some point you've kind of squeezed out. Doesn't mean you can't be long-term minded. You just, like people don't keep stocks that are average. They want to be in stocks that are above average to great, right? And in real estate, that's actually in some way, it's not as liquid, but it's easier to determine, right? Like, I don't know if a stock's going to turn around next year, but I can see when I squeeze the most out of the property and where I could take that equity and switch it into another property and then squeeze the most out of that. And it doesn't happen from buying a property and keeping it and giving it to Benny. I'm going to buy, I'm going to own another. This one property is going to be anywhere from, 6 to 40 properties before he ever owns it. Depending, right? And
money will be moved.
Yes, but it will be the same money. It's still a long-term mindset. Everything I do is long-term mindset. It just, once I realize that I've done it and the market's right, I do it. I don't force it either, right? Like, my plan might be, I'm going to get rid of this in 2 years. In 2 years, if it's not the right time, I'm not selling it just because I got blinders on. I used to have blinders on. I don't anymore. I pay attention to the market. What does the market want me to do with this property? And it actually is pretty clear. It's a lot easier than people think once you take the blinders off and you stop listening to just like, there's one way to do it. Well, no, there's multiple ways.
Yes. And combining strategies and financing methods, all that even multiplies it bigger when you have the skill to be able to combine things. Yeah.
Yep. Exactly.
Okay, cool. We are at time, and I thank you so much, Tim, for joining me today and giving us the lowdown, the high ground for mortgages here in today's economy.
My pleasure.
All right. Thank you so much. See
Yep,
you,
take it easy.
see you all next time.